Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. American assets sell off after Moody stripped the United States of its top credit rating, pointing to political strife and a ballooning budget deficit. In the meantime, President Donald Trump said he'll have a phone call this morning with Presidents Vladimir Putin and Volodymyr Zelensky alongside other members of the NATO alliance, just days after the first direct talks between Ukraine and Russia since the onset of the war. Plus, the UK and the EU negotiators are said to have reached a deal, paving the way for their post-Brexit future ahead of a crucial summit today between Keir Starmer and Ursula von der Leyen. Guy.
Let's talk about these markets, Kriti, and figure out what is happening this Monday morning. We knew that we were going to see some movement. We've been through 5% on a US 30-year this morning. We've backed off a little bit in terms of yield, but we are still selling off when it comes to the back end of the US curve. 4.9872. Remember, 5.17 is the high, so just keep an eye on that number. What you are also seeing is S&P futures selling off. We're down by circa 1%. Is the Sell America trade back on this Monday morning? Not so much for European futures, absolutely flat. And a bid back into the euro. We are seeing that this morning. We're not up by much. 111.84 is the level we're trading at right now. But it's the story around that US 30-year that is really the factor that you need to fold into your thinking this morning. And we are going to discuss it throughout the show. The countdown to the opening trade starts right now. Monday morning, good morning. Ratings downgrades are easy to dismiss. They're in the rearview mirror, but they're hard to ignore. And you're certainly seeing that with the market action that you're seeing this morning. The US 30-year through 5%. Remember, this is an economy that is slowing down. That shouldn't make sense that we are seeing higher yields. What that tells you probably is the market is A, worried about the deficit, and B, worried about stagflation. That has been a risk that's been brewing for a while. The market's kind of parked it to one side. But clearly this morning, we are back and we are worrying about it.
We're worrying about it in the equity market. We saw it in the bond market, too. That 30-year that you had just pointed out to is really the key there, because I'm having a little bit of deja vu from the third quarter of 2023, where so much of the volatility on that back end has bigger ripple effects than even what the Fed is going to be potentially calling as well. But I think it comes down to what Moody's has been pointing to, which, by the way, S&P and Fitch had also pointed to a while back as well, which is just political strife in Washington, D.C. when it comes to the budget deficit. They can't get their act together over in Congress, except they kind of did yesterday when it came to the tax bill. A little
bit of an inch forward. Still got to come out of committee. Still got other committees you want to be thinking about. Still got to think about what is happening in terms of what the Senate's going to do. There are a lot of things that can trip this bill up between now and success, and it feels like we're a long way away from that. And I think the overall read broadly is that this is not going to do much to bring the deficit down. We are not going to see the kind of changes that are required to get the US back on a sustainable footing.
Except Donald Trump is trying with mixed results, right? I mean, and I say this because he's doing steps here that a lot of his predecessors have not done. I'll give you some examples. Federal layoffs. On Friday night as well, we also heard that the Federal Reserve, through attrition, is going to get rid of 10% of their workforce over the coming year. So there is this idea here that perhaps the job layoffs, at least they're attempting, I should say, big kind of red flag there, or disclaimer there, that they are attempting to kind of bring this down. The tariff story is not helping, but that was the initial idea that they campaigned on, that this idea of DOGE, this idea of tariff revenue would offset some of the pain you're seeing.
Do you think the deficit is going down or up?
Do I personally think that? I'm not an economist. I can't make that call.
It looks like at the moment all the arithmetic from the economists suggests that the deficit is still going to continue to rise. Basically puts more pressure on what is happening with the bond market. The bond market's getting nervous. We're north of 5%. This is an economy that is slowing down. You shouldn't be seeing this. This is an economy that needs lower, not higher yields, yet the market is pricing in big term premium because it's worried about what the inflationary outlook of the tariff story, but more importantly, it's worried about what is happening in terms of money flowing into America, the ability of others to buy. There are a lot of things going on here. You get much further north from here, you're going to have problems. How do those problems get resolved? Are we heading for a shock here? And how does the administration respond to that? Because the efforts you lay out are quite small compared with the relative overall size of the US debt situation.
Well, you lay out the fact that this economy is slowing down. That's another battle that Donald Trump's administration is trying to fight here, because they're also dealing with a looming deadline of the midterm elections as well.
Yep.
And that's where the tax cuts, which is why this tax bill is so important, these tax cuts are getting kind of rushed through and pushed through, but they're getting expanded as well. We're not just talking about corporate tax cuts or middle class, we're talking about Medicare and Medicaid as well. These other carve-outs that the tax cuts they were going for are now bigger than they initially anticipated.
So what happens to the deficit?
I know how math works. Don't worry, I'm not denying that the deficit is higher. I just don't have the predictions for it. But that's just one piece of the equation. Of course, the geopolitics raging in the background as well.
You bring me on to Russia. Let's talk about what is happening. We are anticipating some calls are going to take place today. We don't have a lot of timing around what those calls are going to look like and exactly what the level of confidence is. It's interesting. The readout from Peskov at the Kremlin is that a face-to-face between Zelensky and Putin is not completely off the table. Trump is saying that he needs to basically make this happen, and the only way that this issue is going to be resolved if he has a face-to-face with Putin. At the moment, it seems very unclear about kind of what has to move first to make all of this happen. Is it a Trump-Putin meeting? I think we'll probably know a lot more by the end of today. The Europeans have spent the weekend basically trying to figure out exactly how they influenced Trump in his conversation with Putin and what exactly he is going to offer. Because over the last 24, 48 hours, he's been very negative on Zelensky, and I think that's raising a lot of concern in Paris and Berlin and London.
Another weekend, another photo of European leaders huddled around a phone that I imagine is on speaker. I think it's also important to keep in mind that on Friday we did have those direct talks for the very first time between Ukraine and Russia since the onset of the war. Low-level talks, but still a conversation between the two sides, during which it was reported that Russia is still talking about control of the over 5 Ukrainian regions, the ones that have been contested for quite some time. So are we really making that substantial progress? It doesn't seem like it just based on that. But again, what did Donald Trump say when in the Middle East last week? He said Vladimir Putin isn't going to go if I don't go. So he's very clear that he needs to kind of take a bigger role here than perhaps he had led on last week.
Yeah, but kind of who makes the first move? Does he make the first move? Does he need to be? He likes to be invited to these things. Is Putin? I don't know how this process unfolds from here. Kind of what causes the next step to happen. Anyway, let's come back to that one a little bit later on. There's another story that I want to focus on as well. It looks like progress is being made between the UK and the EU. Maybe some sort of long-term fishing deal which would allow a veterinary deal to get done. It looks like there's going to be some sort of movement on freedom of movement as well, particularly for obviously the younger cohort. What is going to be the impact of that? You saw the papers over the weekend talking about this being kind of surrendering of UK sovereignty once again. Obviously the more right-wing papers suggesting that. But it looks like some sort of progress is going to be made. And it's going to be really interesting. People are starting to do the maths on what this could mean for the UK economy and what this could mean for trade. This could be a big push. Well, this could be a significant factor going forward in terms of the economic data that we're going to see out of the UK, which has been hobbled. There's also a standard story here as well, which is really important too. If the UK is more aligned with the European Union on standards, it just allows British business some certainty on what they're dealing with and allows them maybe to push the export story a little bit further. But this is about an exercise in certainty. British business wants certainty. Any time-limited deals don't necessarily deliver that. So how far forward are some of these deals going to get done?
You mentioned the food bit, the fisheries bit, and of course the agricultural checks as a part of that standards question. There's also one aspect of this, which is the defense story. And one of the reported pieces of this was that could the UK ultimately access some of the funding that's coming out of the EU as well. Unclear on what that is, but potentially something in return for this one of the sticking points, that youth mobility scheme that you were talking about, access to the 150 billion euro EU defense fund. So I'm curious what the readout from that is.
The contributions, like how does it work in terms of the money? I think that will be interesting, but basically I think the sense seems to be that is the easy bit. That's going to be this kind of the centrepiece of all of this, but in some ways that's the easier bit from a political point of view to navigate. We need to get back to what is happening in the markets. We'll do that in just a moment. What is happening with the US 30-year? What's happening with the dollar? Jordan Rochester is going to be with us from Mizuho. He's the fixed strategy head. We'll talk to him about the fixed income side and the currency side. Anand, Menon, UK in a changing Europe, joining us to talk about the deal. What kind of a deal is it? What kind of impact will it have between the UK and the EU? Emmanuel Cau is going to be joining us, Barclays head of European equity strategy. Are we back to selling America, buying Europe? Kind of feels like that a little way this morning. And then a little bit later, we're going to talk tech. Cathie Wood is going to be joining us from Ark Invest, where, of course, she is the CEO.
I'm curious to hear her take on all the headlines over the weekend. In the meantime, as we talked about, we do have that UK-EU summit today. Our very own Lizzie Burden is going to be on the ground covering that for us. But we also have a G7 finance minister meeting in Canada as well. I imagine the deficit story on both sides of the Atlantic very much going to be a part of that conversation as well. Plus, data in the back half of the week, I think, is where the markets are going to keep their kind of eye on. Global flash PMIs on Thursday, the German IFO data as well, and the UK consumer confidence and Japanese CPI on Friday. This is all crucial ahead of next week, which is, I think we're going to get some kind of central bank speak next week as well. So this is a good ground in terms of the inflation story and the deficit story. Perhaps lots of market moves on those.
What is going to drive the action this week? Is it going to be the data? Is it going to be what happens with the politics in the United States? Trump is going back to an awful lot of business that needs resolving. He's had a great week in the Middle East. You do wonder about kind of what is happening with the AI trade off the back of that. But let's park that for a moment. He's going back to a lot of unanswered questions, inserting himself back into US politics. What happens on the deficit front? What happens with these markets? What's the ripple effect in terms of the downgrade? I think he's got a lot to deal with going back to Washington this week.
He absolutely does. And I think to your point, the domestic story, and specifically how quickly this tax bill progresses and what the carve-outs actually look like, because as you said, there are several hurdles here. That is something the markets could actively trade on because of this warning coming from Moody's. Extra sensitivity at the credit ratings agency has put on what's going on in Congress.
Absolutely. Let's get you some of the other stories you need to know this Monday morning. First of all, let's start with the former president. Former President Joe Biden has been diagnosed with an aggressive form of prostate cancer that has metastasized to his bones. However, Biden's spokesperson says the cancer is hormone sensitive and may respond to treatment. In a post on social media, President Trump said he was, quote, saddened to hear about the diagnosis. Portugal's ruling centre-right coalition has won the country's snap election. According to early results, Prime Minister Luis Montenegro's coalition got nearly 33% of the votes. The far right and the socialists are competing neck and neck for second place. The centrist mayor of Bucharest has won Romania's presidential runoff. Independent candidate Mizuho Dan secured more than 54% of the vote, defeating the candidate of the far right. The victory is helped by Romania's highest voter turnout in over a quarter of a century. I think it was north of 60%. And rounding out a trio of elections, the mayor of Warsaw and ally of Prime Minister Donald Tusk is poised for a narrow win over a pro-Donald Trump nationalist in Poland's presidential votes. The two will face each other again in a runoff election, which will take place on the 1st of June. So in some ways, a victory for the centre this weekend. In most of the elections, yes, Portugal's drifted a little bit further right, but basically none of the kind of extreme outcomes, particularly in the Romanian election, which caused so much fear, have come to pass. Voter turnout was super high in Romania. It looks like many people have basically decided they don't want to go down that road and push forward and go further right. So it's going to be interesting to see whether or not actually Europe... Can Europe calm down on its move right? Is that going to go as far? Has Donald Trump basically taken some of the wind out of that move right here in Europe? And I think that increasingly looks like it's the effect.
Which I don't think a lot of people thought would be the Trump effect, necessarily. No. We thought it would exacerbate, we thought it would magnify, not actually swing in the opposite direction. But, of course, there are still several holdouts. Hungary, for example, is one of them, among a couple of other pockets around the world that we've got our eye on. But you're right, I think a win for the center is absolutely the way to put it. Some runoff elections, though, that we'll have our eye on across Bloomberg Television and radio. Coming up on the program, Ryanair announcing a follow-on share buyback worth 750 million euros, but says its growth outlook depends on trade talks and tariff wars. We'll check on the stock at the open and hear from their CEO. Plus, Bloomberg understands the UK and EU trade talks have reached a deal ahead of a key meeting in London today. We're live on location. But up next, right back into the markets and the fallout from Moody's U.S. credit rating downgrade. Is a Sell America trade back on? You can see it in futures this morning. Can you see it in the bond market? We're going to dive into the details. If you have any questions for your own, for us, or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. We inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
That was, of course, Scott Bessent, the US Treasury Secretary, on NBC's Meet the Press. By and large, attempting to downplay Moody's US credit rating downgrade, which are kind of easy to dismiss but hard to ignore, as we're seeing in the market this morning. The market's certainly not ignoring it, Valerie Teitel.
Yeah, that's right, Guy. We have seen kind of a return to that sell America theme this morning. We're seeing all U.S. assets in the red, the equity market, the Treasury market, and the U.S. dollar. Take a look at this 30-year yield. We're trading above 5%. And, Guy, on my mind is when is the conversation going to become about cycle highs in the 30-year yield? The cycle high for that 30-year yield is 5.18%. So we're less than 20 basis points away. But take a look at this S&P future move. We're down 0.9%. If we compare it to previous downgrades, it really does pale in comparison, but that's maybe because Moody's is the third and last one to move on this AAA rating for the U.S. In August 2011, the S&P dropped near 7%. August 23, that was the Fitch move. We dropped near 1.5%. So a bit less tame, but it does come at a maybe politically sensitive time as this bill is making its way through the House that does have a lot of spending entailed. And because, it's exactly what Scott Bessent pointed out there in that Meet the Press interview, we have a historically wide budget deficit already, near 7% of GDP. It remains historically wide for a peacetime non-recession scenario. The market is questioning maybe just when lawmakers will wake up to what the market is trying to tell them.
Or what will force them to wake up. Maybe an alarm clock is about to ring. We're about to find out whether or not that is the case. Valerie, thank you very much indeed. Joining us now, Jordan Rochester, Head of Fixed Strategy at Mizuho EMEA. Good morning.
Good morning.
Is there an alarm clock coming? Is there a warning bell coming in terms of what we're seeing in the United States? Is 5%, 5.17, 5.18 the top on a US 30-year? Do we go further than that?
I think we go further than that in terms of the 10-year. I think that's where our sort of view is.
In terms of the 10-year?
We get to 5% by year end on the 10-year.
Okay.
The long end is more susceptible to these risks, though, of fiscal sort of fears, though. So look at Japan 30-year, UK experience with Liz Truss. The long end's got to be where the pain is. But this news on Friday, late in the day, is not really game-changing for what we already knew. We already knew the fiscal, I guess, was extreme, the 7% deficit that Valerie just had on the screen. Sure. We knew that the fiscal spending is going to increase once they pass the bill in the House and the Senate sometime around June and July. And look at the rest of the world. You've got Europe looking to spend more, Japan looking to spend more, China potentially as well. It's a world where we've got extreme amounts of issuance, large deficits. Who's going to absolve that? So this market is going to test them. It's not going to be like Liz Truss, because Liz Truss was an extreme example of not using OBR forecasts. It's like getting rid of the CBO for the US, and also firing several heads of the civil service who were there to try and help her pass a more fiscally constrained budget, who were hampering her. We're not seeing that with Trump.
What's the implication of a 5% US 10-year?
Well, every time you get up there, usually you have a growth slowdown at least. And I think that's what could potentially happen if we get to the 5%. Right now, though, I'm of the view that the recession fears were overblown. We've seen Donald Trump has really rode his tariffs back, and there's potential for more to come with talks with the EU, with Vance over the weekend. But every time we get to 5%, usually the economy slows down, and therefore we don't go much further. This could be a scenario where if we see large fiscal stimulus on the back of extreme stimulus elsewhere, but growth holds up, maybe we hold up 5% for longer than usual. But you take up the long-term chart, the 10-year, every time we get to 5, that's usually the time to receive.
The recession odds, though, have changed really in just the last 7 days, right, since the de-escalation from Scott Bessent's kind of meeting in Geneva with his counterpart. Is the volatility not enough to create the same kind of stagflation that the full tariffs would? Just the uncertainty of knowing that in 90 days or even just in 7 days, again, it could go in the opposite direction.
Well, stagflation is when inflation goes up and growth stalls. We're talking about a scenario now where inflation's going up, but also growth recovers too. So actually stagflation fears go down ever so slightly. And firms will build up margins again. So perhaps we're in a sweet spot at the moment in the market where the S&P can test a new high this year because growth expectations are going up at the same time. So in answer to your question, actually stagflation has become less of a concern in the very short term.
You mentioned earlier that there are kind of deficit concerns around the world, and it's a question of who absolves them. Who do you think absolves them first? Because the same problems that the U.S. is having, the U.K. is having, France is having, Italy, Spain's having. I mean, I could give you a list of other countries that are having the same ones. Who has a bigger deficit problem?
Well, when you're the reserve currency of the world, usually you say the US doesn't really have that problem. But as we saw with tariffs, that became a big question. But it is the likes of the UK where there is an issue. That's why the Chancellor is fiscally constrained. I mentioned the list of suspects, Japan, US, potentially Europe and China. I didn't mention the UK because we've got a fiscal rule that she's running up against the buffers. If, for some reason, she needs to raise taxes and so forth, then the market could test the UK once more.
Where's the dollar going?
Well, I was surprised how quickly we've reversed from the news last week when US-China tariffs were softened. We had a decent rally in the dollar. I thought we'd get to 150 in dollar yen. We got close to it, but we didn't get all the way. But we do expect dollar weakness by year end. And it's not because of this whole sell America theme that some people are pushing. Instead, it's because rest of world growth is accelerating in the second half, in our view. Because of all the fiscal spend from the US, Europe, Japan and so forth, I can see a decent recovery in the second half. Right now, it's pain, because we're seeing the data, the impact of tariffs for all these countries. But let's assume by July or over the summer, tariff deals are agreed, you can raise your growth expectations by year end.
You seem to be hanging your hat on tariff deals getting done. What is your probability of that happening? It does seem as if we're in a situation where deals have been done, but they're not bringing tariffs down by that. They're bringing tariffs down by a lot, but they're still relatively high. What is the drag effect of tariff deals getting done, but at a relatively high level? 10%, north of 10%. Historically, these are very high tariffs still.
They're what we expected, though. So there's a difference. So going into Liberation Day...
But it haven't shown up in the data yet. So the market's not pricing the negatives. It's only seeming to price the positives at the moment.
I think we priced the negatives very quickly, right? We had a very sharp sell-off. We had essentially a de facto bear market, which didn't last very long because Trump rolled things back. But in terms of the tariff levels, we expected a 15% average effective rate. We're currently around the 19% or so, and give it a few more deals, we could get to where we were. Firms have essentially said to the administration they can potentially weather that, but it will require higher prices to do so.
What does that leave? Well, I'm going to pick your currency brain here because there's three currencies that I can't quite work out, and this is why I ask who can get to the deficit story the fastest. Between the dollar, the euro, and the pound, I'm curious which one snaps first. And I ask this also in the context of the UK-EU summit today. How tradable is that when it comes to, if you're not positive on the dollar, how do you quantify the gain or the green on the screen for the euro or the pound?
Well, these are famous last words. Today's UK-EU summit isn't really tradable. And the reason I say that is because everyone knows pretty much what's going to happen. There's going to be a deal on joint youth mobility scheme. There's going to be a closer partnership. This is a stepping stone to improving relations with the EU. But most of it is about, and the main reason they're having this summit in the first place is on defence spending and defence cooperation. It's not really improving the trade situation. We're going to have some steps to improve the trade, such as reciprocation over professional services such as veterinary and food, but that's not going to absolve the OBR's problem that there's a 4% hit to GDP from Brexit. This summit's not going to do that. So the UK is going to be one of the ones that I think is challenged, because I think the UK is going to have a big slowdown in inflation that the Bank of England currently doesn't expect, and we'll see more deeper cuts from the Bank of England.
That sounds like more positive on the euro than the pound. Is that what I'm hearing?
Absolutely, because the Europe has more capacity for fiscal spending thanks to Germany compared to the UK.
All right. Jordan Rochester, head of fixed strategy over at Mizuho, telling us a little bit about, I think, every region of the world we've covered in that conversation. We thank you so much. We're going to continue our coverage of that UK-EU summit. Coming up, British Prime Minister Keir Starmer set to host European Union chiefs at a summit, as we mentioned, aimed at resetting post-Brexit ties. We're going to be speaking to the director of the think tank UK in a Changing Europe, and we're live at Lancaster House next. Stick with us. This is Bloomberg. 30 minutes from the start of the opening trade, starting to see risk sentiment in Europe soften more than it had just 30 minutes ago. I'm looking at futures here. They're unchanged on Euro Stoxx 50, but the FTSE 100 is certainly pulling back, down about 0.3%. Compare that to the States, though, and this is nothing. Really unchanged, very cautious outlook, Guy. when it comes to the futures picture.
Let's talk about the bond market. Equity markets aren't where the action is, despite what Jordan Rochester believes. The bond market is where the story is. Look at what is happening with the yields this morning. We are seeing them pushing a little bit higher. The real story, though, once again, is in the United States. A 30-year through 5%. That tells me the cycle high is 5.18, 5.17 and change. Are we going to get through that? How quickly do we get through that? How big a shock will it be when we do get through that? Because it feels like it's coming.
Absolutely. Not reflected in the European markets, though, Jesse, and of course the geopolitics raging in the background as well, and plenty of negotiations in various parts of the world. Let's bring that conversation right back here to Europe. The UK and the EU are said to have reached an outline deal on strengthening their post-Brexit ties. It comes ahead of a meeting between Prime Minister Keir Starmer and the presidents of the European Commission and European Council. In London this morning, our UK correspondent Lizzie Burden standing by at the venue. Lizzie, walk us through the progress that we can expect.
Well, good morning, Kriti from Lancaster House. We're waiting for those leaders to arrive, and this is a crucial moment. It's the first UK-EU summit formally since Brexit, both sides wanting to show unity in the face of Donald Trump's tariff war and Vladimir Putin's war in Ukraine. So strategically, the landscape fundamentally has changed, but the old red lines of Brexit remain, and leaders on both sides of the channel domestically, politically, want to project strength in the face of right-wing opposition parties. So as you say, the haggling went on into the wee hours of the morning, but a deal has been reached, and we're expecting it to come in three parts. One, on defence and security. Two, on how they're going to cooperate in future, and that includes things like travel, access to e-gates, passport control. And three, on a stronger alliance going forward in this geopolitical uncertainty that we're seeing around the world. But really pressure on Keir Starmer to show that he can stand up to Brussels, because of course he has already agreed to this US trade pact, including that minimum 10% tariff, much to the chagrin of some EU officials who are doing their own negotiations with Donald Trump. So today he's under pressure to show that this is not the surrender summit, as it's already been labelled by the opposition Conservative Party.
Yeah, there was a lot of that in the papers over the weekend. Lizzie, thank you very much indeed. Lizzie Burden at Lancaster House throughout the morning, giving us the latest on what we are getting out of these talks and the deal that has been done. Anand Menon, director of the think tank UK and a Changing Europe, joining us now to give us his take. Good morning. Is this a breakthrough? Morning. Should we describe this as a breakthrough?
I mean, it's a significant event in the sense that it's the first, as Lizzie said, it's the first post-Brexit summit, and they are going to agree on some really important substantive things. That being said, I think it's important to bear in mind that this is probably the first step in negotiations that are going to go on for a long, long time, because there are a whole load of issues, not least on the economic front, where the two sides have agreed to talk but haven't yet come to agreement.
What kind of economic effect would you expect to come from this? Will this be a deal that shows up in the data?
To be honest, no. And that's largely because of the red lines on both sides. The UK government has said they won't be joining a customs union and they won't be joining the single market. That's where really all the growth is tied up. And the EU, for their part, have been very clear that they're not going to let the UK just pick and choose the bits of the single market we want to be in. So given those two sets of red lines, then actually there's relatively little that can be achieved in aggregate economic terms in terms of rubbing away some of those trade barriers that exist because of Brexit.
Anand, talk to us about what comes next here. What is the next step from whatever preliminary outline of an agreement is due to be announced today?
Well, what I suspect is we'll hear today, on top of probably a security and defence pact, which it sounds like they're ready to sign, but in a whole host of areas, whether it's energy trading, whether it's agriculture, whether it's youth mobility, the two sides will state their intention to sort of sit down together and come up with solid agreements. So I think over the next few months, there's going to be quite a lot of negotiating going on between the two sides to try and bring home some of those specific sectoral agreements.
Anand, I'm curious here, when it comes to the youth mobility scheme, which we know is a kind of non-starter for the UK in a lot of ways, what would the UK potentially want to get it across the finish line? Maybe not in the near future, but eventually.
Well, there's been a lot of rumours about it, and what I can say is one of the things we've heard is that the UK government is keen to cap the numbers. The EU side wants youth mobility for under 30s. The two questions, therefore, is whether there is a cap on numbers and how long people are allowed to come for. Because as you were saying in your introduction, one of the things that Keir Starmer is looking out for is a reaction from the Conservative Party and from Reform UK, both of whom have already said essentially that they're willing to cry betrayal if anything that allows lots of new people to come into the country is agreed.
And then, in terms of how this is likely to be received, though, in the UK, there is obviously a great concern within the Labour Party about what is happening with Nigel Farage and the policies that he is pushing at the moment. In terms of the effect that this is likely to have on that, how long will we know? How long will it take, do you think, for the effects of what is agreed today to show up? Like, how long, both in terms of the politics, which is probably relatively quickly, but also actually in the data and the economic effect? You've already said there's probably little data economic effect. I'm trying to work out what the upside and the downside in all of this is.
Well, the upside is, if you take the agricultural deal, for instance, it's absolutely true that in aggregate economic terms, this isn't going to move the dial on UK growth, but it's going to make it easier to trade agri-foods across the border. So if you're an importer or an exporter, you'll feel that. It'll probably have a role in minimising food price inflation, because there have been studies that show Brexit has driven up food prices. And, of course, equally importantly, having a deal on agriculture will help the two sides minimise the impact of the border between Great Britain and Northern Ireland that has been in place since we signed the protocol. So there are real practical effects, some of which will be felt as soon as this deal has been signed. But again, to reiterate, in terms of aggregate growth, this agricultural deal is not really going to move the dial.
How important is the defence deal? That seems like relatively easy ground to deliver upon. There is clearly an external threat. The European Union and the UK both see that threat. Does this deal go far enough, therefore, given the scale of the change that there is in terms of the threat from Russia and elsewhere?
I think it's important symbolically and substantively. Symbolically because given what's going on in Ukraine, given the uncertainty created by President Trump, it really would have been a pretty awful look if the European Union and the UK couldn't agree on some basic steps to collaborate more on defence. In substantive terms, we're expecting that the defence pact that they sign will allow the UK some access to the funds that the European Union now has at its disposal for defence procurement. But the final thing I would say is we don't know the details of the deal yet. And there is a big debate going on in the European Union at the moment about how much access to give the United Kingdom. One of the key questions, actually, is how the European Union defines Europe. If there's an expansive definition of Europe that includes the UK, they'll be quite generous in giving us access to these funds. If, on the other hand, member states like France have their way, then they will try and limit access to funds, because improving European security is about improving the economic prospects of the European Union as well, and that means putting barriers up to non-member states.
Anand, can you walk us through some of the examples of how that access could potentially work? If the UK were to ultimately get access to those European funds, what are the options in terms of actually deploying that?
Well, I think the options are the European Union has got 2 or 3 schemes where EU money is being made available to help underwrite collaborative arms manufacturing schemes between European firms. Now, clearly, from a UK point of view, it wouldn't have been great had the big UK defence firms being excluded from that. And for both sides, I think, if Europe is serious about increasing its strategic autonomy, about taking on a greater share of the burden of defending itself, given what is widely seen as the increased unreliability of the United States, then I think it makes sense for the UK to be involved in this. UK is one of the most significant defence players in Europe and has one of the largest defence industries in Europe. So in that sense alone, building up Europe's own capacity to defend itself, I think it makes sense to have both sides working together.
Anand, a quick follow on that, in that some of that European defence funding, and at least in the EU Defence Fund, has been touted as perhaps getting more funding if you get joint EU debt, which of course has been a contentious issue in continental Europe as well. But if you do start to use, say, the bond market to access that kind of funding or raise that kind of funding in continental Europe, would that limit the UK's potential access to those funds?
I mean, there's absolutely no doubt that if that happens, there are going to be some very, very tricky discussions about how much the UK should pay in, how much the UK should have access to. The other side of that coin, I think, is if Europeans are serious about significant new investment in defence, it raises some interesting questions about whether there should be closer links between European financial markets and the City of London, because, of course, we have deep capital reserves here in the City of London. Certain European politicians, former Italian Prime Minister Enrico Letta has been calling for far closer relations, partly in order to help fund that rearmament. So it might be that if the two sides manage to work together, this will spill over into other areas of cooperation as well.
Anand, a final question to you when we talk about, and you had mentioned this in terms of the UK and the EU deciding how they want to approach the volatility coming out of the United States as well. Would there be a world where that policy and that reaction, separate from defense in terms of the tariff and the trade deal, is a coordinated reaction between the UK and the EU?
I suppose anything's conceivable in the current world. What I would say at the moment is the UK position has been quite interesting. Keir Starmer has insisted again and again that the UK doesn't need to choose between Europe and the United States. I suspect that that's a very different position to that the European Union is going to take up. The European Union, of course, is engaged in a fairly sort of acrimonious tariff row with the United States and hasn't got some of the opt-outs that the UK has achieved. One danger for Keir Starmer, I think, is if he walks that tightrope of not choosing between the EU and the US, he might end up irritating some of his interlocutors in Europe who look at the UK and say, you haven't even chosen a side in this, and we're having this tariff war with the United States. Why should we make concessions to you?
A tricky position for, I think, all involved. Anand Menon, Director of UK in a Changing Europe, joining us this morning. We thank you so much.
OK, let's talk about what is happening in the airline sector. Ryanair looking to the summer months for a bookings boost. We are going to hear from Michael O'Leary. He spoke to Tom McKenzie a little bit earlier on. We'll hear some of what he had to say in just a moment. This is Bloomberg. Let's talk about the markets. Let's talk about the US 30-year at 5% and pushing higher. Paul Dobson, Bloomberg's executive editor for Asia Markets, joins us now. Paul, do we go higher from here in terms of yields? And if so, what is the impact of that on global markets? Big question.
Lots of big questions. Good morning, Guy. Everybody's paying attention to those longer maturity yields in US Treasuries. We breached 5% on the 30-year today. There's some key levels coming up. Just a little bit higher than that will take us back to November 2023. And then beyond that, back to the levels that we last saw in 2007. So it's been quite a long time since yields have been this high. People are worried about US spending. They're worried about the US deficit. And they're worried about US policies that are alienating investors as well. And that's why there's pressure on the Treasuries market. All of that extra spending requires extra debt sales. It brings more supply into the market. You need to encourage people to want to buy your bonds. And, you know, if you're using other things that are trying to deter them or risk deterring them at the same time, then that could potentially continue to push up yields and see that steeper curve as well, which is what we're seeing. So that's the risk scenario. If the US can get inflation under control, if the Fed can start cutting interest rates, maybe that acts as a damper on some of those trends.
Paul, talk to us a little bit about what that sell America trade actually looks like. Because, yes, you see it on the long end of the curve, but I'm looking at the front end of the curve, and let's say, or maybe not the front end, we'll call it the middle, the 10-year basically. It's only higher by 3 basis points, where it feels like the equity market is having a more pronounced reaction to it. Walk us through that disconnect.
Yeah, well, today, Triti, you know, we've got a hat trick, right? We've got a weaker dollar, we've got lower US stock index futures, and we've got some declines in Treasuries and that steepening curve all in one go. And so I think that talks to this idea that there is some souring of demand for US assets in general. I think the really long-term trend is that people think the dollar has peaked. They think that holdings of US assets, particularly the stock market, by foreign investors is so enormous that it can't go any higher and it is going to start to unwind. And that's what some of the money managers around the world have been telling us as well. And so that's the long-term trend. How we get there and what it does to prices over time remains to be seen. But I think that, sort of like a bit of a segregation. And by the way, if you're in the US, the appeal of other markets and putting your money elsewhere, it kind of is only going to grow.
Paul, Chinese data, let's just talk about it. The manufacturing numbers looked okay, but the consumer story still looks very weak. Is that the right read?
More or less. I mean, so economists have been a little bit too bearish on China of late. If you look at the economic surprise index from Citigroup, it's the highest in about 18 months. So the economy is doing a little bit better than people expected, although part of that is because everybody's been trying to load all those goods onto ships as quickly as they can and get them out the door before all of the tariffs hit, and also trying to find other markets. The consumer is the problem, the risks there. That's what everybody's still worried about, and how you can really get that going again to spur growth is what we're looking for.
It's funny that we're talking a little bit about this kind of Chinese consumption story, Paul, that's coming back into the forefront, because when you look at kind of the post-Liberation Day and I guess, Geneva Mechanism Day, if we can call it that, action, it feels like U.S. assets have completely recovered. I'm using the stock market as that proxy for that, even the bond market as well. Can you say the same for Asian markets that have dealt with similar carnage?
So I think for China, it just about nosed its way back above levels that we were before the big introduction of all the tariffs. For the rest of Asia, in dollar-denominated terms, it's been storming higher. It's been having a great time of it and outperforming and touching new highs as well, partly because of that dollar underperformance against Asia currencies, as well as the general comeback, which eventually fed through into tech as well and brought up some of the Asia's markets as a result of that too. So I think, everybody's acting as if those tariffs never came along in the first place, which perhaps is a little bit unwise or foolhardy, given the fact that they are still in place, they are still reasonably heavy, and there are still deadlines that we're going to have to get to and hoops that we're going to have to jump through in order to keep them at bay as well, Kriti. So for now, just as with the US markets, there has been that recovery. But it feels like from here, what good news could you get on tariffs that would drive the market higher again? That's the question that people are going to have to be asking themselves. Maybe on the European side, you get that. For Asia, it would have to be, something particularly spectacular to get people excited, I feel.
Absolutely. Paul Dobson, we thank you so much for that context. Bloomberg Executive Editor for Asia Markets joining us this morning. You get more up-to-date analysis from him and the team. MLIV Go is the function on your Bloomberg terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So Ryanair gave a trading update earlier this morning that was pretty much in line with what analysts were expecting. And the CEO, Michael O'Leary, spoke to Bloomberg earlier about the impact of tariffs on the sector. Have a listen to what he had to say.
I think our experience with Trump and the tariffs is, he talks tough and then they walk it back pretty quickly. You saw the deal with the Chinese, the deal with the UK. I'm not sure it will. I'm not that worried about tariffs on commercial aircraft.
Does the deal with the UK and the US, does that mean you could source the aircraft from the UK then? Would you look to that?
It's a possibility. I mean, one of the alternatives is we could take the aircraft in through the UK, but ultimately we have a fixed price agreement with Boeing, and our discussion with Boeing, our tariffs are Boeing's problem, not ours.
So that was the Ryanair CEO speaking to Bloomberg earlier about the impact of tariffs. But as I say, the trading update itself pretty much in line with what the market was looking for. The summer commentary actually pretty positive in terms of where their bookings are going. We can see from the screen here that Ryanair has actually outperformed EasyJet, the big rival, over the past few years. So potentially we'll see if that continues in today's trading. Then we've got the maker of Guinness and Johnny Walker, Diageo, giving an update as well. They have kind of reassured on the trading the sales expected to grow very slightly on an organic basis over the next year, according to the company. But that stock really hit hard by the tariffs. We've seen a big drop down in recent years for Diageo. Potentially we might see a bit of a boost into some of the peers as well today, like Remy, Pernod, AB InBev, Heineken as well. The beer makers, given Diageo is in both spirits and beers, could be a bit of a read across that sector today. Then we've got Commerzbank on the radar too. The German Chancellor saying that he does not expect currently a big risk of UniCredit doing a takeover for the company, because currently the shareholding required for a full takeover to come through is actually below the threshold, and they don't expect that to be reached in the near term. But there's Commerzbank. We can see when UniCredit came in initially for this potential bid back in September. We can see the stock rallying up since then, so we'll wait to see whether this is digested as kind of a negative on the deal going through. But keep an eye on Commerzbank in Germany this morning.
Joe, great stuff. Thank you very much indeed. Some of the single stocks that we're going to be watching as we work our way towards the open in around 6 minutes' time. This time last week...
I know.
It's a week.
Yeah.
It's a week since the trade deal was done with China, and the markets exploded on the back of that. Following Monday, we're back talking about Sell America. I find the kind of the round trip in terms of sentiment quite amazing. Now, obviously, that the two are not evenly balanced. We are seeing a little bit of selling today, but I find it didn't take long. And it just tells you about the volatility that we're going to be seeing and how whipsawed these markets continue to be right now.
Yeah, I mean, the fact that we went from about a month of carnage post-Liberation Day, to your point, recovered it all in a week, and going back to, yes, to Sell America, but again, it's not the same pain trade that I think we saw after Liberation Day. And,
no.
and we are seeing, of course, this massive divergence in futures. We are seeing that this morning between Europe and the U.S., but the dollar has been consistently weaker across the board, which is coming back to Jordan Rochester's point, which is that the deficit story has not gone away and will continue to drive these markets.
This is the Liberation Day was a kind of acute story. The market kind of reacted very violently. This is a chronic story. It's long. It's long lasting. It's going to have an effect that's going to kind of be with us for really quite some time. Yes, you can kind of dismiss the downgrade, but it's just emblematic of an effect that is happening in terms of what is going on in the US economy right now. Anyway, European futures actually look okay going into this morning in terms of the market open in 5 minutes' time. US futures are significantly more negative. We'll come back to that story in a moment. It is time for the market open. This is Bloomberg. Monday morning, Friday feels like an age ago, doesn't it? But let's talk about what happened Friday, just to remind you as we go into the Monday morning session. Europe went out here. US equities continue to rally after we had closed. The problem with that is that since then, obviously, we've seen a significant rolling over in futures, particularly US futures. Why is that? Obviously, the downgrade that has come through over the weekend is having the effect. We're all watching what is happening in the bond market. So you're getting quite a big difference between what you're seeing in the States, where we're down circa 1%, and what we're seeing here in Europe. So you've got the Stoxx 50 down around 0.2%. FTSE's down a little bit more, 0.3%. DAX down around 0.3%. We're down less than 0.5% in Europe, whereas we're down a lot more in the United States. Now, Europe didn't climb as much on Friday, and therefore maybe doesn't have quite as much to fall. But it'll be interesting to see whether or not there's more downside as we work our way through the early stages, Kriti, of the session this morning.
Absolutely. Today, the focus may perhaps be on the deficit, the Moody's credit rating, but the tariff impact still very much showing in some of the narratives when you hear about the individual stocks. Ryanair is one great example. When we're talking about the U.S. impact, a lot of worries about whether or not people still wanted to travel this summer to the U.S. and even within Europe as well. It looks like Ryanair is saying the latter is true, where they are seeing some increased summer travel demand, but sticking to those domestic borders. And that's going to be something that comes in line with the share buybacks, perhaps received quite with open arms at the open. Diageo as well talking about increased sales growth in the second half of the year, saying that their tariff story can be cut in half. The tariff impact can be cut in half because of cost cuts to the tune of about $500 million. Then, of course, some European news in the banking sector. Commerzbank as well in the spotlight, as Joe Easton was telling us earlier, Guy. Friedrich Maersk saying no risk of UniCredit taking over the bank at the moment.
Those are some of the single stocks that we are going to be watching. Let's talk about the top-down macro picture. What are we seeing in this market this morning? Remember, it was only a week ago that we were talking about the trade deal with China and the huge effect we saw off that. This morning feels like a very different narrative. The FTSE 100 down as expected a little bit this morning, but not by much. Let's call it 0.2%. I round up. But we are anticipating maybe 0.3%. These are small margins. The Stoxx 600 is down by 0.3%. Again, I round a little bit higher. But these moves pale into comparison with what we're seeing over in the United States, where we are seeing, obviously, futures significantly lower. The DAX, clearly nothing is happening in Germany this morning because the DAX is open quite quickly. And we are down by 0.2%. The IBEX is a little softer as well. The CAC out early as well. Europe is not the story this morning. We're down by 0.4%. None of this really, I think, Kriti, gives us much of a steer on how markets feel, because the focus is very much on the other side of the Atlantic. What is happening with the downgrade? What is happening with the deficit story? All of the politics being folded in as Trump returns off his Middle East trip to what is a very different picture, you could argue, in Washington this morning. But that's something maybe for a little bit later. This morning, European markets a little softer.
A little softer on the index level, Guy, but I feel like when the news... Let me get a little bit of a respite from the news and the tariff story. It's worth paying attention to some of the individual stock moves as well. So a bit of a mixed picture when you look at the sector story. Healthcare, telecom, travel, leisure, utilities, all in the green. The rest in the red, but again, by tiny margins. I think it's the individual stock story we need to be paying attention to, because from an index perspective, your biggest contributions to the upside are Diageo and Ryanair, both of which are very much reflecting and talking about the impact of the news coming out of the United States. I think Diageo is the key one to focus in on, just given that that is the weighting that is moving this market the most, both in the FTSE and the Stock 600 as well. Remember, they had talked about $500 million worth of cost cuts, and so the tariff impact is about $150 million. Mix that in with some higher sales growth in the back half of the year. And they're saying the tariff bite may not be as big as its bark, or at least what the stock market was pricing in. Those shares higher by about 1.6% this morning. Ryanair also very much in focus. That buyback story helping them out.
So Michael's interesting on this. He was hinting in his conversation with Tom this morning that actually maybe he'll take more of a back seat on the buyback because everybody else seems to want to buy my shares. Why should I be chasing it? Which I think is a really interesting point. So he's just thinking about kind of what he does with the buyback going forward from here. He's quite confident in what the share price is doing. The biggest effect for Ryanair right now is what is happening with the oil price. It is huge. They are hedged at the moment in the kind of the 80s. That's going to come down into the 60s. That is a huge tailwind for Ryanair. If they can lock in that kind of effect in summer 26, summer 27, that's going to have a massive impact on the bottom line. So it's going to be interesting to see whether or not the oil price, and you see what's happening with BP this morning. BP down, Ryanair up. Just that's the effect that you're seeing. Oil price majors are giving back some ground. Ryanair is up. It's doing very well. Remember as well, actually, that's a longer-term chart. My eyes deceive me. The story this morning is still on what is happening with the deficit story, but it's the other thing I just need to mention as well is lots of ex-dividends in the market. BNP is one of them.
Absolutely. We're going to keep an eye on those. And of course, like you said, today is a day where we don't have a macro narrative necessarily moving this European market. Some of the individual stocks are floating to the forefront. Let's bring in an expert here. Emmanuel Cau joins us around the table, head of European equity strategy over at Barclays. Pleasure to have you on the program. Thank you, as always, for coming in. Talk to us a little bit about how we should be thinking about the bond market moves off of the deficit. I'm going to say this right, off of the deficit story in the States, but also the deficit story here in Europe. How does that get factored into the calculations around the equity market?
Yeah, good morning. I mean, I don't think the Moody's downgrade is really a game changer. I mean, this should not have a tangible impact on the bond market, or I don't think any forced selling of treasuries or any issue on the money market, etc. But this is just a reminder that the weakling here is the bond market, right? And to some extent, all the other markets, all the other asset classes depend on the valuation on the bond market, right? So we do have a preference for equities over bonds because we think equities have earnings and a pretty resilient corporate sector as backstop or support, and bonds are basically backed by weaker and weaker governments in most developed markets, basically. But I think we're getting to a point where after 15-20% rallies in equities, which was largely valuation-driven, obviously equity market is getting again more sensitive to valuation and bond yields. And what we've been saying is that 4.5% 10-year yield in the US, 5% 30-year yield in the US, are getting close to the danger zone for equities. If you look at the last 10, 15, 20 years, whenever we got to those levels, we started to see a bit of wobbles in the equity market. So we're going to need at some point earnings to really support the equity market. And I think for the equity market to really shrug off this persistent pressure from rates, we're going to need to see at some point more evidence of earnings resilience and growth resilience. I think this is where the debate is in the market right now. Can the equity market cope with higher yields if they're here to stay?
So historically, when we've seen that 5% level, for example, in the bond market, it's been because it's harder then for say, a big tech company like Apple or whoever, to then go in and borrow at those levels, right? That's the logical piece. There's another story here of whether liquidity is a positive or a negative in that factor, and that if you're holding more cash, a higher bond yield actually hurts you. But if you're holding, but you could also be holding more cash and actually helps you navigate the situation. In this environment, is more cash on a balance sheet a good thing or a bad thing?
I think it is a good thing. And what we've seen, by the way, over the last couple of years is a pretty resilient corporate sector coming to its own rescue whenever we had stress in the equity market. So buybacks, for example, share buybacks, have been a massive source of support to the equity market. And I think in the last couple of weeks, again, we are seeing buybacks are contributing to this rebound in the equity market. And the cash-rich businesses, buybacks-heavy stocks, have been basically outperforming for some time. So yes, if you are having a strong balance sheet, a lot of cash to deploy or to invest in your business, you might be able to cope with this bond market volatility. If you have very poor balance sheet or high leverage and the cost of funding are going higher, that's going to be an issue for you. And there is a clear polarization in the market between good businesses, good balance sheet, and investors want quality basically as the number one factor in their allocation, and the low quality stock which have been lagging mostly in the last couple of years.
This time last week we were talking about China and the trade deal. It's amazing. It's just a week ago. Was the market too quick to price in the all clear, to say that everything's okay again? Back up almost in a straight line off the lows that we've seen. What do you make of that, and what signal do you take away from it?
My signal is that there is a clear, I think the Trump administration is very willing to de-escalate this as soon as possible. And even though we lack real substance, so there's still a lot up in there and to be negotiated, I think those positive trade headlines will keep feeding market optimism, right? And I think there are reasons to see the glass being half full in a sense that we still don't know where the tariff will settle, but there is a path towards the escalation. And we are yet to see more deals with other countries. But the big one was China, and we've gone from 25% aggregate tariff to 14%, which is very much close to what was our base case ahead of Liberation Day, right? So I don't think tariffs are the key market driver anymore, but obviously.
So what is the key driver now?
I think it's very much, the bond market the fiscal policy in the US, the tax bit, but a lot of what Trump will be doing on the fiscal side will ultimately depend on the resolution of this tariff crisis, right? So we think there is still room for de-escalation on the tariff side, and I think there's still a lot of concern in Europe in particular about tariff. Even though we're not talking about it today, there's still a question mark about the deal that we're going to have at some point between US and Europe. If you are seeing confirmation that 10% is a tariff that we're going to have in Europe, I think the market will be able to move on, right? So a lot of good news are priced in, but I still believe that, as the market gets more positive headlines on this de-escalation between US and other countries, that might still help to keep the glass half full for investors.
What's going to outperform going forward? Is it going to be US equities? Is it going to be European equities? Or as Michael Hartnett's been pointing out over at Bank of America, is it going to be emerging market equities? What do you think is primed as you look across the landscape and you go into meetings and you get kind of feedback from everybody? What do you think is the area of outperformance that we are going to see in global equities?
I mean, there's a lot of hype around this Sell America, and maybe it got a bit overdone at some point. And what we saw in that post-Liberation Day relief, we had US actually outperforming the rest of the world. But I think there's still a lot of appetite to diversify away from the US. Look, on our side, we turn overweight emerging market ex-China equities compared to the rest of the world months ago. So we're seeing a weaker dollar. And, tariff de-escalation should be supportive of emerging markets. Their central banks are in a much better position to support the economy. They don't have too much inflation to fight in the first place. And we are in the pro-European camp. It's not smooth sailing when you invest in Europe because there's always something to worry about. And the execution risk on the policy front is very high. But again, what we are seeing this morning between UK and Europe is a step in the right direction. It's more convergence on the policy front. Europe has less of an entrenched inflation issue to deal with. And again, there's a bit of pro-growth mindset coming back. And what Germany hopefully will be doing should be a game changer for the region, right? So valuations are cheaper in Europe, positioning is cheaper, the growth story is pretty decent, and we think there is far less of a political risk on the market.
How far do you think that trade has gone thus far?
Well, Europe is still cheap. Europe is still trading in line with long-term average multiple. If you look at the long-term investors or asset allocators, they are not overweight Europe.
Right.
Germany is still trading below the long-term average. Earnings forecasts are 3% in Europe, 10% in the US. So yes, there is a lot of hype, as I said, around this Sell America. And now Europe has to deliver. I don't think the trigger, I don't think the hurdles they have to clear is that high. And I think the bar for positive surprise is getting much higher for the US.
Emmanuel, valuations has never been Europe's issue. No one has ever said Europe is too expensive to own, or if they have, there are rare moments in history where that's happened. Arguably, in the first quarter of this year, people said maybe this was gone a little bit too far. Growth has always been the concern. But can you really trade the policy convergence, as you say, between the UK or the EU, or can you really... I'm curious how much faith you can really put in this fiscal spend coming out of Germany, something that's earmarked for 10 years. What kind of visibility do you have in 10 years when the rest of Europe is still struggling to generate growth?
I think there's a narrative now which helps this invest in European team. I agree with you that we're going to have to deliver on that, but I think we have now capable people in Germany driving the policy agenda. To some extent, again, positioning is not very high, and I think there is appetite to diversify away from the US. So South America is half of the story, but you need something to capture the money. And as well, I think this shift in the policy dynamics in Europe, where now there's a bit more self-help and, again, intention to support the economy, might help, right?
Is lower yields in Europe, there's talk this morning of cutting rates below 2%. How big a factor, how big a tailwind could that be?
I think the growth policy setup is more favorable in Europe. Again, we don't have a huge inflation issue. Yeah. There's more room for the ECB to cut rate. Germany doesn't have a fiscal imbalance. They have too much, basically, savings. They have too little deficit, so they have fiscal headroom to support the economy, which is a luxury these days. Not many countries in the developed world have excess fiscal capacity, basically, right? So again, the narrative is exciting. Now, can they deliver on that? Time will tell, but I don't think the price to pay to believe it's going to work is that high. If you think about the US, you are paying more than 20 times to believe that the US can maintain this exceptionalism. And that's obviously, coming with a maybe less exciting risk reward.
But if the argument, and you made the argument on Europe here, if the argument for Europe is the fiscal spend that may be coming down the pike, why aren't the funds going in more force to Asia or China specifically, where the fiscal spend is much larger and the reach for those companies are much larger?
We think they should. That's why we went back to emerging market a month ago to say, look, there's an opportunity in emerging market. We think the inflation backdrop is much more favorable. We don't see much of a fiscal issue there. We think there's a valuation argument to own emerging market. And in a world where dollar is likely to stay weaker for longer, that makes life easier for a lot of emerging market central banks, right? So I think there's a case for broader diversification away from the US. But this is just starting, and bear in mind that investors for the past 20 years were very much in love with US exceptionalism. It takes time for people to change their mindset and their investment strategy, right?
The muscle memory of the last 15, 20 years, buy the dip, buy the dip, buy the dip. That takes a long time to come out of the story. Nice to see you. Thanks indeed for stopping by to see us. Emmanuel Cau, Head of European Equity Strategy, joining us from Barclays. Core 6, quick look just to see what's happening. This is the picture you find yourselves with this Monday morning, fairly mixed. A little bit of defensiveness, as you can see, with Nestle maybe trading a little bit higher. But broadly, the tech sector under a little bit of pressure as we look to maybe some weakness coming out of the United States. Joe's got his eyes on Ryanair, which appropriately this morning is in the green. Joe.
So Ryanair is doing well, as you say, Guy, in the green pretty firmly today. One of the best performing stocks in Europe. We're up around 4% at the moment. Now, some of the quarterly sales actually look a little bit weak, but the guidance in terms of where the bookings are going into the summer or the end of the summer, towards the end of the summer, do look pretty strong, according to analysts' notes I've been reading today, and also potentially those comments around the trade war, the tariffs not having a huge effect, as O'Leary was telling Bloomberg earlier today. Positivity coming into that stock. So we are up a good 4% on that one for Ryanair in the airline space. Then over in drinks, Diageo doing well, up 2.5%. The company's net sales, again, it's pretty much in line with where the consensus was, but some people probably expecting a bit of a downgrade. And then another thing I read was that North American consumers potentially bringing forward some orders, so pubs and restaurant chains buying up some of the Diageo products ahead of tariffs coming through. And finally, Diageo actually holding an investor day at the Guinness factory in Dublin tomorrow. That is probably the best place you could ever have an investor day. I'd love to be at that one, but that's in the focus for Diageo, the maker of Guinness, gaining it today around 2.5%. Then in terms of M&A, the tech space, we do have Just Eat getting this bid, an all-cash bid from Prosus. They've got the price on that. It's just above €20. We already knew that this deal was coming through, but that is very slightly higher than I think some were expecting. So the stock edging up very slightly, not too much of a gain, but it is in focus on the M&A front. Then the other M&A story was Commerzbank, the comments out of Italy, or out of Germany rather, that they do not expect an Italian takeover and a takeover by UniCredit to come through anytime soon. We're seeing some calls on that one very slightly lower, but pretty much in line with where we were trading on Friday for Commerzbank. But those comments from Merz, the Chancellor over in Germany, saying they don't expect a takeover anytime soon. Nonetheless, it is on our radar. Then another one on our radar was in Alzheimer's. We did get news of the FDA clearing a blood test for Alzheimer's. That is seen as positive for companies making drugs to treat Alzheimer's. So we're seeing BioArctic up. We're seeing a little bit of a gain in Roche as well, but that one in focus today. There we got Roche on the screen, up 0.2%, potentially some positivity on the Alzheimer's front, lifting those stocks this morning.
Joe Easton from our equities team walking us through some of those early movers. We thank you so much and certainly appreciate it. From an index level, it's still fairly quiet despite the movers that we are seeing, at least here in Europe. Stateside, a different story.
It's getting uglier and uglier as the morning progresses. You've now got NASDAQ futures down by 1.5%. You've got EMEA futures, the S&P down by 1.2%. So people dismiss this ratings downgrade. But there is a wider picture, which is kind of the deficit matters, what is going on is really important. And the politics, yeah, we're kind of inching maybe towards a deal, but there's so many hurdles still to cross in terms of what this deal is ultimately going to end up producing. I really don't know. But the knee-jerk reaction is maybe it's time to roll over some. Like, it's a week ago since we had the great Treasury. It's just taken a week, and suddenly that's kind of the tone has shifted, and the Nasdaq is off pretty hard. You're seeing that reflected in European tech stocks this morning. Names like ASML are down, so you're getting the AEX underperforming. The London market's also underperforming. There's a huge number of ex-divs in the market this morning, so you kind of park those. But we have been rolling over since the get-go on US futures, and it gets uglier and uglier as the morning progresses.
Absolutely. That's the equities picture. The bond story, as you pointed out, the deficit story really driving that one. It's the sustainability and the sustainability of the volatility, and that if you were starting to see bigger spikes of the long end of the curve, how much can the corporates, like let's say your big techs that have the most liquidity, actually navigate those? And how quickly does that volatility show up in things like financial conditions and the ripple effect into mortgage rates, et cetera? And that's where I think September 2023 is the key quarter to look at, because we have this exact conversation. Deficit, politics, a budget, a Treasury sell-off. We weren't at Sell America just yet, but we were getting there. And I'm just curious how much time we need and how much margin of a move we need before people really hit the panic button.
Yeah, it doesn't feel like they were quite there yet. This doesn't feel like panic this morning in any shape or form. It's interesting, actually, you are seeing a bit at the front end. So actually the curve's steepening up. So there are two different narratives being told in what is happening in the United States as well. But like 5% on a US. Jordan Rochester was talking about 5% on a 10-year. Yeah. I think that would cause some consternation by the end of the year. By year end. Yeah. The 10-year still very much within its range at right now, 450. On that Treasury yield. Coming up, we go right back to the micro picture. Ryanair saying the biggest threats to profit growth this fiscal year are tariffs and geopolitical risks. More from our interview with the airline CEO, Michael O'Leary. Next, shares higher by about 4%. Stick with us. This is Bloomberg. Look at Ryanair this morning. The shares are up really quite strongly on the back of the ongoing buyback, which is something that Michael maybe will kind of tamper down a little bit going forward from here. But demand still looks really good. That's really positive for the summer picture going forward from here. You've got this buyback being announced. You've got a fuel story which looks great. The stock is up, therefore, really quite nicely. We spoke to Michael O'Leary, MOL, a little bit earlier about the outlook.
I was written to by some US lawmaker asking me not to guarantee that we won't buy Chinese aircraft, and I wrote back politely saying, go to hell. I'm not giving you, we will reserve the right to buy aircraft wherever we so wish. We remain
Not certified yet, Comac.
No, they're not certified and won't be certified for another 5 or 10 years. But been written to by some congressman in the US whose iPhone was made in China, asking Ryanair not to guarantee not to buy Chinese aircraft.
Yeah.
We would give no such guarantees. I don't see any great prospect of us buying a Comac aircraft. The Boeing are making great aircraft. You look at our numbers this morning, an awful lot of which are being driven by the Boeing MAX 8200s. Those aircraft offer us 4% more seats. They're burning 16% less fuel. They're transforming our economics. And I think you add those new aircraft to the declining cost of oil for the foreseeable future. And I think not just Ryanair, but the airline sector in general looks set for 2 or 3 years of reasonably strong earnings.
Talk to us about the oil price. You're seeing prices now about $62 a barrel on Brent. You hedge around oil prices. Are you hedged to the upside, or are you well protected on lower prices?
No, we hedge straight for jet fuel into plane. We were hedged in the last year. So the results this morning, we were hedged at $79 a barrel. We're 85% hedged this year at about $76 a barrel, about a 4% fuel saving. We took advantage of the uncertainty post the Trump tariffs or Independence Day, whatever it was last month. We hedged about 40% of summer 2026 fuel at about $66 a barrel. This is jet. Jet at the moment, spot is about 67, Brent is 62. That's about a 13% saving on fuel into next year. Our annual fuel bill is about $5 billion. So if we could hedge out the remainder of next year at $66 a barrel, you're looking at savings of between $700-800 million going straight through to the bottom line, which would create an enormous opportunity for Ryanair to really meaningfully lower the cost of air travel across Europe next year.
And that's what he's always relied on, that impact of lower prices and the pushing that effect has onto consumer demand. Michael O'Leary, MOL, talking to Tom McKenzie a little bit earlier on. Charlie Wells is here with an update on the numbers. What he was talking about there, the oil price, that stands out to me. What stood out to you?
Yeah, so look, they had all of these headwinds in the year, right? And they still got this 1.61 billion euro after-tax profit. You think about the uncertainty. You think about all the Boeing delays, the issues that they had to deal with there. You think about this value-sensitive consumer that they had to contend with there, but they really deftly navigated on price there. So you see, coming in at the high end of their guidance on profit, passenger numbers, they beat expectations, 200 million passengers just north of there. I was one of them. They had a slight miss on fleet, and again, that's where some of this Boeing issue comes into play. And then I think the real numbers that come out, it's that 750 million euro buyback. Investors are really liking that. They're saying that it's just too early to provide guidance for the year ahead. And then interestingly, when you dig into this report, they sound bullish on Boeing here, which is a real change in tone, I think, for the industry, saying we are working closely with Boeing to accelerate deliveries and are increasingly confident.
Where does the trade war fall into all of this?
Look, it seems like this is evidence of executives across industries, but Michael O'Leary in particular, picking up on the Trump playbook and knowing what it is and how to use it, right? So he's talking about how Trump talks tough, but then quickly kind of withdraws some of these threats. And so I think that's a sign that he can navigate this pretty deftly.
Absolutely fascinating conversation coming out of Ryanair and Michael O'Leary himself. I thought it was really interesting that he talked about getting a letter from a U.S. lawmaker. You can really see where the sentiment is over in the States as well. Charlie Wells there breaking down some of those numbers for us. Coming up, we stick with that conversation. We're going to check the pulse of the U.S. economy, get the outlook for tech. And Cathie Wood from Ark Invest joins us next. This is Bloomberg. This is the opening trade. About 30 minutes into today's session, seeing some red on the screen in Europe. You are starting to see some of the risk sentiment on this side of the Atlantic catch up to what you're seeing in the States. Let me walk you through some of these numbers here. The Stock 600 down about 0.5% this morning. A lot of the concentration is in the French index, of course, but the FTSE 100 as well, down about 0.5%. Take this with a wagon of salt, though, because we've got a ton of ex-dividends hitting this market as well. So that's going to be factoring into that story. But then, of course, you compare this to what you're seeing in the States. I'm looking at a futures picture down about 1% on S&P 500 E-minis, about 1.5% when you look at the NASDAQ story. The bond market, the dollar, all selling off, and it's coming from one key piece. Moody's downgrading U.S. government debt from its top rating on Friday. The credit rating firm citing successive administrations' failures to deal with rising U.S. debt and deficits. That's just one part of the market conversation. The other, of course, is going to be the geopolitical story, the tariff story, and whether or not this market is juicy enough to invest in. On that and more, I'm pleased to say we're joined now by Cathie Wood, founder, CEO, and CIO of Ark Invest, joining us around the table this morning. Cathie, a pleasure to have you here in London.
Thank you, Krita.
Welcome to the table and to the set and to the UK. I want to start off with the main kind of headline of this morning, which is Moody's has now been kind of the last domino to fall in terms of this credit rating as well. On top of that, you have these tariff deals. On top of that, you have these deficit concerns. How does it feel right now to be an American investor?
Well, it actually feels a lot better right now than it did at the beginning of so-called Liberation Day, when it seemed chaotic. Our hypothesis at the time was that there was a lot of negotiating going on behind the scenes. And when we saw Treasury Secretary Bessent really take over from Peter Navarro, that was an important moment. We knew the negotiations were perhaps about getting non-tariff trade barriers down, as well as getting tariffs down. And if that is where we end up, that's a tax cut. That's a positive. But as the turmoil was the inferno seemed to be blazing, I know that there was a lot of uncertainty just because of all of the rhetoric. But I think we're beginning to, understand now that this is more of a tax cut and a freeing up of markets. I mean, even here in the UK, I didn't know we couldn't sell our beef into the UK. Now we can, or our ethanol. So, and hopefully it's a two-way street that the U.S. is opening up as well. So it's a win-win for our trade partners.
That's the perspective on the trade story, but you used a key phrase, which is tax cuts. There is a bill and legislation going on through Washington, D.C. right now of further tax cuts, bigger perhaps than what Donald Trump had initially campaigned on as well. That is fueling concerns about a ballooning deficit as well. Give us your thoughts on that. There's a lot of folks who are saying this is not the time to be investing in the States, not just because of the volatility emanating out of Washington, but because of that ballooning deficit. How do you trade in that environment?
Well, I am a Laffer disciple, so the Laffer curve. And we have some evidence now. In the first Trump term, he cut the corporate tax rate from 35%. We were uncompetitive. A lot of companies were moving out of the United States. 35% to 21%. And of course, that faced a lot of criticism. Corporate tax revenues since then have gone from $200 billion to $500 billion as more companies relocate back into the U.S. We're more competitive now. So if tax rates are too high, then cutting the rates typically leads to more revenue. Now, one of the other things we think is going to happen, and consider the source, there is so much innovation taking place right now, technologically enabled innovation. We think real GDP growth is going to accelerate well beyond what people expect now. So this idea of growing our way out of deficits, many people are dismissing that. I just gave you a very good example with corporate tax rates. And if you look in the United States at revenues as a percent of GDP, individual tax revenues, they're roughly around 18, 17% all the time. If tax rates go higher, people either stop working or find ways to shelter the income. So we think that government spending up closer to 24% is the problem, and we need to continue to show some discipline on that front.
Are there better opportunities inside the United States or outside of the United States right now?
It depends what sectors you're talking about.
Let's talk about technology.
Well, the wonderful thing about what's going on with artificial intelligence in particular is that the cost of innovation is collapsing. Our AI training costs are dropping 75% per year. AI inference costs 85 to, if you believe DeepSeek, 95% per year. So we think we are on the lookout for more innovative companies popping up in the rest of the world. I do believe the U.S. was at risk of losing innovation. Certainly under the last SEC chairman, Gensler, we almost lost the digital assets revolution to other countries. Now it's coming back. I think under this regime, technology in the U.S. will do very well. And one other thing I'd like to say about that, the Mag 6, many people lump them as technology and thinking they represent technology. They quintupled in market cap from 2019 to 24. If you look at the rest of what we call technologically enabled innovation, it was up a mere 30%. We believe the market is going in the U.S. is going to broaden out and reward some of the companies that have lagged badly.
Examples? Any examples? Which areas? Give me more specific.
Sure. Well, a lot of the multiomics names, they are AI enabled these days. Multiomics is life sciences. Yep. So CRISPR Therapeutics is curing sickle cell disease and beta thalassemia. We have, of course, Coinbase. It is starting to make a run. Palantir's had a magnificent move, just got into the S&P 500. Roku is the operating system for connected TVs, certainly in the U.S., and number 2 in the U.S., and now spreading around the world. We have other multiomics names like Twist Therapeutics, which is going to be critically important to the blood tests that are going to help us identify cancer in stage 1 or maybe even before stage 1 as tumors shed or polyps shed into the blood.
So basically, don't buy the Bag 7, look for other areas.
If we look at our portfolio, we have faced a tremendous headwind over the last 4 years, valuations coming down to roughly a market multiple as measured by enterprise value to adjusted EBITDA. We've worked with S&P on this. Yep. We were at 275% premium to the S&P. Now we're roughly a 10% premium. So if you ask us, again, consider the source, we believe that innovation, technologically enabled innovation in the U.S., away from the Mag 6, which have been rewarded handsomely, is highly undervalued.
Cathie, a lot of that innovation, though, that you're touting, and even just and you mentioned the SEC as well, the kind of change in antitrust sentiment as well, that is fueling the tech sector and the biotech sector specifically. A lot of that has come from expenditure coming from the government as well. And you kind of touted this idea that when you bring down some of these government expenses from a deficit standpoint and kind of rein in that spending, at what point does that start to hit the innovation ecosystem that you're talking about?
I think that innovation is part of the program, and especially with Elon Musk at the helm. He has been at the helm. He's going to be stepping aside. I think he has been shocked and has surfaced how old the technology is and how inefficient it is and how much we are doing manually. So I think
at government.
In the government sector, we've had Palantir go in, starting with the Department of Defense, and now it's moving into other parts of the government and increasing efficiency enormously. We desperately needed this. Some of these systems were 50, 60 years old. And so if we look at the FDA, for example, we're already seeing more transparency and streamlining, which is absolutely essential. Deregulation. Regulations have been strangling innovation in the U.S. The FDA already has approved, for the first time, a piece of software code which will help in the diagnosis of heart disease. Is getting rid of animal testing because it doesn't work when it comes to monoclonal antibodies.
But Cathie, some of the examples that you're giving, and you mentioned the Defense Department as a great one, DOJ as another, I'll add a third, which is the FAA and a potential transformation there. That all requires investment in the infrastructure and the technology that you're talking about modernizing. And yet we've seen the Trump administration pull back on some of those federal contracts and that defense spending. I think Palantir is actually one of the few exceptions that you're seeing for that rule. Do you really expect that to continue, given the pullback on that spending?
Well, having watched from Poland personally on an on a base, it was an army base actually, them training the Ukrainians, we've learned that war is changing. It's becoming much more electronic. And our systems, we call them the primes, the big defense companies, they produced elite equipment. The world's going towards commoditized when it comes to drones. And of course, in Ukraine, they've been using DJI drones. And we've been learning a few things about them. So we're spending too much in the wrong places as technology changes the nature of war.
Are big tech companies spending too much in the wrong places? This huge investment that we're seeing at the moment in AI, is that going to be able to continue? At the moment, the conversations I'm having with people are talking about costs crashing, and you kind of obliquely referenced this a little bit earlier on. Costs are coming down. Are we certain that all the investment that we're seeing at the moment in big tech, in AI, is being spent wisely?
No, we're not certain. We're never certain. Whenever you see a flood of capital moving into one space, which it has, one of the things we think about is software as a service. Internally at Ark, there's something called vibe coding. I don't know if you've heard about it, but we're all coders if you think about it. Natural language processing, vibe code. We can go to ChatGPT or Claude.
Write some code for me.
Yes, and say, build me this website. And it will happen. Or
who makes money on that? We still haven't figured out who's ultimately going to be making the money.
We're going to, because we're going to lower our costs.
Okay.
We're going to lower costs. We're going to eliminate.
But that's not what's priced into the market right now. At the moment.
No, I think the biggest. So there are three huge areas. One is massive productivity gains that every company can enjoy.
Yeah.
That's one, and you'll see that more in efficiencies. Two is the largest AI project on Earth is autonomous transportation, whether it's robo-taxis. So Tesla, we have said for quite some time, is the largest AI project on Earth. The most profound AI applications are going to be in healthcare. If you think what makes AI tick, it's data. We have 37 trillion cells in our body.
Sure.
That we're now analyzing, and we can analyze because of AI.
At the moment, the market is pricing, giving the big multiples to the companies, the picks and shovels companies, the companies that are making the AI, the companies that are making the data centers, the operators of the data centers. That's where the valuations are at the moment. Are those on the wrong valuations?
They've corrected quite a bit.
Sure.
They've corrected quite a bit. I think the better question is, are some of the opportunities I just mentioned, especially in healthcare, are they recognized at all? They are not. They are not recognized at all.
Cathie, speaking of the healthcare story, there's a question here, and I know you specialize in kind of biotechnology specifically, but I know that you also have in previous iterations of your holdings talked about other pharmaceuticals as well. There's a question right now, especially in the European market where so many people are holding pharmaceuticals and biotech as well as part of their portfolio, of what a tariff impact or reciprocal tariff impact may look like in terms of the raw materials needed to develop that kind of innovation you're talking about, but then ultimately passing on the cost of that technology to the consumer. And I know, again, you're speaking to a very kind of innovative sector or piece or kind of cross-platform or cross-slice of the market. But I'm curious about what that does to margins, what that does to the actual costs involved with creating something. As I'm looking at your holdings in Tesla, Palantir even, I'll throw CRISPR Therapeutics in there. Walk us through the margin story with the context of things might be getting more expensive in the short term.
We think the healthcare sector has the opportunity here to take returns on R&D, which are in the low single-digit range, way down from the golden age of the 80s and 90s when they got up to 20, 30%, back to 15, 30, even 40%, because AI is going to collapse the cost of drug discovery and development. We think the number of years it will take to discover and then launch a new drug will shrink from 13 years to 8 years. We think that we're going to have molecular diagnostic tests, as I mentioned before, to diagnose disease much earlier. And so we're going to move from sick care spending, which in the U.S. is 85% of healthcare spending, more towards therapies that actually cure. So if you look at CRISPR therapeutics and others, we think that the combination of sequencing technologies, artificial intelligence, and CRISPR gene editing is going to cure more diseases. We're already seeing cures in sickle cell disease and beta thalassemia, as I mentioned. They have one that will compete with Lipitor or the statins in the works right now, which is showing amazing results. Again, once and done, not having to take statins all your life, which have all of these side effects. So I really think healthcare is the most underappreciated beneficiary of AI out there. But as you mentioned, your viewers have a lot of pharma holdings. You have to make sure that they are harnessing these tools, because the old way of doing things is not going to work anymore. It's very inefficient. There's a lot of guesswork.
Yep.
And technology is going to change that. You have some great pharma companies, but they have to harness these tools aggressively. Otherwise, newbies will come around and nipping at their heels, it will seem like, and then surprise.
I think we're all going to feel better after this. Certainly science sounds a lot better. Cathie, great to see you. Thanks for stopping by as ever to come and see us here in London. Cathie Wood, founder and CEO and CIO of Ark Invest. Coming up, we are going to be talking about the Russian and US presidents, expecting to speak a little bit later on today. We're still waiting for details on exactly how this is going to happen. We're going to discuss why Vladimir Putin is unlikely to offer any meaningful concessions. That seems to be the theme right now. We'll talk about that next. This is Bloomberg. A51, welcome back. President Donald Trump says he will have a phone call with the Russian President Vladimir Putin today to discuss how to stop the war in Ukraine. This, of course, comes as Kremlin forces launched the largest drone barrage over the weekend since the start of Russia's full-scale invasion in February 2022. Let's bring in Ollie Crook from Berlin to talk more about this. Ollie, what do we know about this call?
Yeah, well, we know it's happening at 10 a.m. Eastern time. We know, which is 4 p.m. Central European time. We know that this is after a sort of week that saw the failure to get any progress on that ceasefire, that 30-day ceasefire that the Trump administration, that the Europeans, that the Ukrainians have been pushing. And then Putin said that he would have, potentially diplomatic talks instead. And that basically after those failed, the Trump administration and Donald Trump himself basically determined that nothing is going to get done until there is a direct conversation between Donald Trump and Vladimir Putin. And that direct conversation will take place a little bit later today. And what we had in the lead up to that was a flurry of diplomatic activity. We had Friedrich Merz, we had Keir Starmer, we had Emmanuel Macron, Giorgia Meloni all speaking to Donald Trump yesterday. We had J.D. Vance sitting down with Zelensky for the first time since their sort of confrontation in the Oval Office over the weekend in Rome, all basically trying to get Donald Trump's ears, speaking their sort of corner, trying to get the message across from the European side anyway, that Putin is the impediment to peace, Putin is the problem, and that without basically serious sanctions on Putin, no progress will be made. We do know now that there is a list of sanctions that the U.S. is considering if Donald Trump determines that Putin is the problem. These are the so-called bone-crushing sanctions that Lindsey Graham has proposed. There's bipartisan support for that if Trump wants to move forward on it. This is talking about sanctioning second-party countries that are still buying Russian oil and gas, which would be very, very significant. The question is, how far are we from basically that convincing by Zelensky and the Europeans that Putin is the problem? Either way, no matter what happens on the call today, we edge closer to something, which is the Americans having to make a choice. Is Zelensky the problem? Is Putin the problem? Or is it a problem that's too complicated for them to solve and that they're going to step back? After this call today, we'll have a slightly better picture. We know that Trump will then, after the call with Putin, talk to Zelensky and some of the other NATO leaders a little bit later in the afternoon.
Bloomberg's Oliver Crook there in Berlin, walking us through what we can expect from what is clearly a very contentious issue just a couple of days after, of course, those very first direct talks between Ukraine and Russia. We thank you so much. Let's get more on a different set of negotiations closer to home on a deal said to have been reached between the UK and the EU on strengthening ties. Leaders due to meet at Lancaster House this morning. Our UK correspondent Lizzie Burden is live on location. Lizzie, walk us through what we expect to be announced today.
Well, Kriti, we are expecting a deal to have been reached. They were crunching at it until the early hours of this morning. 2 a.m. is what we heard. The draft, though, still yet to be approved by political leaders on both sides. But those leaders are going to arrive here at 10:15 a.m. London time here at Lancaster House. There'll be a plenary session at 11 a.m. and then a press conference at 12:30 p.m. But look, this is a significant moment for both sides diplomatically post-Brexit, a moment to show unity in the face of, as you were just discussing, Putin's war on Ukraine, but also Trump's tariff war. And yet you still have leaders on both sides of the channel needing to project strength in the face of the right-wing opposition parties in different countries. What we're expecting, though, in terms of the nitty-gritty today is a three-part deal. First, on defence and security. Second, a common understanding of how they'll cooperate in future, and that includes, for example, access to e-gates at passport lanes. And then thirdly, just a statement of closer alliance through this uncertain geopolitical climate.
They're very hemmed in, though, aren't they? Both sides by domestic politics, Lizzie.
Absolutely, Guy. And as ever, fish, a thorny issue in these talks. Britain wanted to extend the deal on fishing rights that expires next year by just 4 years, we hear. But France said, if you want to just do 4 years on fish, we'll do 4 years on food checks, which of course would create uncertainty for Britain. They also said, we hear, that they wouldn't go for a deal on defence if Britain held up the path on fish. Now, a senior British official told us that that was ridiculous, the idea that Brussels would want to squander the opportunity to show unity to Putin just because France wanted a better deal on fish. But to unlock it, a draft that we have seen shows that Britain is going to agree to reciprocal fishing rights for more than a decade. And in exchange, that's unlocked the path to a deal on food checks and on energy cooperation as well. To unlock defence, the UK has said that it will look towards working on the Erasmus student exchange programme with a time-limited youth visa. So it's been a diplomatic game of chess, but it looks like we've got a deal here.
OK. We'll look to that a little bit later on. The leaders will be arriving at circa 10 o'clock this morning. Lizzie will be there to cover that event for us. Lizzie Burden down at Lancaster House. Thank you very much indeed. Coming up, an exclusive conversation with the EU's foreign policy chief, Kaja Kallas, is going to be joining us 9:15 London time. Looking forward to that.
Absolutely. In the meantime, a quick check on these markets. As we've been speaking, we have seen risk sentiment worsening on both sides of the pond, and specifically when it comes to the dollar. Starting to see some real weakness there, but that is a boon for the likes of the euro and the pound. That does it for the opening trade. The Pulse is up next. This is Bloomberg.